All right, traders, welcome to today's recap. This is Christian from Hertz Tribeca Trade Group, and today is Monday, September 17th. And we got a little bit of a dose of volatility today. Really not that bad in the S&P. And, the reasoning why the S&P wasn't down that much is because same thing that we've been talking about the last couple of weeks, especially last week. I spent some time talking about this. It's it just seems like there's a rotation going on under the hood within sectors. So it's not one of those days. I remember in my trading career, Merrill Lynch, a lot of times you would have days where everything was red on the screen, and maybe the defensives outperformed a little bit better. Now we're seeing something a little bit different. Now this was compounded by the end of the day with trade war fears and a headline saying that there's going to be an announcement after the close. So things actually, the market breadth got worse as the day went on. But, you had a lot of defensive areas that were really holding up pretty well. You had defense stocks that were green for a while, meaning your Lockheed Martin, your Raytheon, that type of thing. Gold miners were up big today. Steel names were also metals and mining, which in that ETF XME, which saw some call activity. That's also that's a combination of steel names and metals and mining. But the SLX ETF, that's steel, it was up close to 1% on the day. And then agriculture names, that's the MOO ETF, was up about 0.5% today. Consumer staples were up 40 basis points. The materials ETF, XLB as in boy, was up 40 basis points. So the reason why I'm going through all this is because it kind of explains why the S&P was only down 0.5%, right? If we shift over to the Qs, oops, that's the wrong symbol. That used to be at one point, it was quadruple Qs. But anyway, the Qs were down 1.4%. And, that goes into what I wanted to talk about for a couple minutes is really the difference between growth and value, right? So there's a couple different indices that you can follow. There's straight VTV, which is value, but I think it's kind of interesting if you look at large cap and small cap growth versus value. So IWN, for example, that is the small cap value. That was at one point, let's see where these things ended. This was about midday today, but you could see the difference, right? Growth really underperforming, especially small cap growth, but you could see large cap, right? 0.1 versus 0.5. So I don't know where these things ended up on the day, but that's where it was basically on about halfway through the day. So why is that? Or I will give you my quick, I said 2 minutes, but maybe I'll make this a little bit shorter. Keep in mind, this week is quadruple witching, right? A lot of people are not familiar with the mechanics that goes behind quadruple witching. Besides the option expiration and futures expiring, there's also what's known as index rebalancing, which isn't included in the four witches, but it's expiration, and this happens quarterly. What that means is the S&P and the NASDAQ, all of the names, not just one-offs, not just one name being added and one name being taken out, but they all reweight back to their benchmarks, right? So, for example, if you look at the S&P components, right, the names, it's a combination of things, right? For the market cap weighted indices, the names that are on the top of the list are your biggest companies, but also they're the names that rallied the most, right? So what happens is the index providers will only strike the weighting once a quarter. So that happens September, it happens December, March, and it happens June, right? And then what happens is, so these shares, this position stays fixed as long as there's no corporate actions or anything like that. But this position in the SPYs will stay exactly the same, or I should say the SPX, the ratio should stay exactly the same, and that's determined. They'll strike those shares just once a quarter, and then what floats is the price. So the weightings change, and the weightings will get larger and smaller depending on the variable that changes within the quarter. That variable is price. So, and you could see this in the equally weighted ETFs, right? So in an equally weighted ETF, everything should have the exact same weight to it, right? Let me just move this back. XRT 8. But if you look at XRT, for example, again, these will also reweight on Friday. You could see that CVNA and Super Value, Wayfair are the top weights in here. Now, again, it's not that big of a difference because everything was basically 1% when they struck this last back in June. But what happens is, and why are these names on the top of the list? Because these are your best performers. So they naturally become the biggest weight because the price has gone up, right? If you look at CVNA, which I don't think I need to bring up a chart for this one, but this is Carvana, which has been on a tear, right? And then the names that are the underperformers, if you go all the way to the bottom of the list, and I'm sorry, this is a long-winded, but if you look at, let's say, I don't know what SAH is or Cato, but let's see the difference in the price or in the right? This is an underperformer, so therefore it's lower weight. So what has to happen, right? And what was another one that I saw here? SAH. Sorry, I get that wrong. Right? It's basically done nothing. So it's been an underperformer in the index. So what has to happen? And I don't know if this name is staying in the index, but what happens on Friday? And whatever all the street portfolio desks know this. They do the math. Also, if you go to the S&P index website, you can see this. So what'll happen is on Friday, which again all the index will rebalance close. The actual rebalance will happen close of business on Friday. The losers or the names that are the smaller weights will have to be bought, and the names on the top of the list. Right, so if you go back to the top of the list, like so CVNA, all of those will normally have to be sold, Wayfair and so forth. Now, what the portfolio managers do ahead of this, ahead of Friday, is they position ahead. Sometimes they even do it before the known announcement, which happened last Friday. But anyway, so this will create some volatility in the market because the winners will have to be sold. And this is just one index, but you could go through biotech, which is the XBI ETF. You could go through, all of the different sector indices. The reason why I bring up the equal weight ones is because they're a little bit more dramatic. But all of the market cap indices, all of the sectors, all of the major indices, the only thing that doesn't basically rebalance for the most part is Russell. They're on a different schedule. But so that will cause a lot of fluctuations, and I think that was partly responsible for why you see a lot of the winning groups underperform. Okay, so next topic, right? So this is where it gets a little bit hedgy, a little bit difficult because if you had SPY hedges for today, if you look at some of the damage that took place today, right? I'll go through some of these groups, right? But again, we were only down 50 basis points, so it really depends what your portfolio holds. You have to make sure that you've got the right hedge, but this is XHE. This has been one of the best performers, so you have to I pretty sure that right now what you're seeing is winners being sold. That's XHE. This is healthcare equipment, down 2.9%. If you look at, let's say, cyber names, basically there wasn't a lot of news on this stuff. I'm sure there's some single stock stories out there for this, but really it's just the whole group selling off. This is the cyber securities ETF, down 2.25%. This is IGV. This has been one. Again, these are some of the best performers, best performing sectors. Look at the IGV. No news on any of these names really. Software, enterprise application, and infrastructure. There is no news on the majority of these names. I didn't see any story out. Down 2.2%. If you look at the internet group, which is FDN, Frank, David, Nancy. This was down 2.1%. Right, so you could go on, and on, and you could see that really there was some damage going on in higher beta growth areas today. So that should be a temporary thing, right? If you buy into what I explained with index rebalancing, that should kind of clear its way up by Wednesday. And of course, the actual event is Friday, but everybody does the trading beforehand. So it may kind of spill through the week. But next week, that event should be over with. It's a temporary thing. However, I think there's other market forces going on. Clearly, with what is going on with China, I think that is really starting to scare people a little bit. It's becoming more of a reality. I've said for a while now, the longer that this lingers, the worse the more damage is going to occur. So, and I think we've been seeing that defensive positioning take place over the last couple weeks, right? If you look at, for example, low volatilities equities, USMV, where's the volatility in this thing, right? Holding up very well. And even Visa and MasterCard is in that ETF. That's you. And then the other one, right? So that's minimum volatility equities. If you look at SPLV, right, this was down 10 basis points today. So this is where people are hiding out. Both of these saw inflows. Look at the volume last week, right? So people have been positioning. You could see the volume in here, and look at how much higher it is past, right? So the positioning has been going on for months. People have been kind of getting ready for this, and maybe I shouldn't say months, but at least the last couple weeks, we've seen a breakout in a lot of these defensive. So again, that's SPLV and USMV, low volatility, minimum volatility equities breaking out and showing very little damage at all today. So again, really depends on the group. If you're in a lot of those areas that I discussed that were down 2%, a hedge in the Qs or in SPY is really not going to help. But a more diversified portfolio, position sizing is going to help you a little bit more. But hedges, if you're in some of those areas, are not going to help you that much. So the reason why I bring this up is because it can make you think a little bit about how you're positioned and your risks. So equity put call ratio, I think, was right around 1.2% today, or 1.2. So that's pretty high. There was a lot of put protection. So let me show you what we've, at Tribeca Trade Group. One of the new things that we've been has been something that a new project that we've been working on is aggressive option reports, and you can see the screen that I have up on the left side is called OptionX, right? So this is a feed from OptionX, but you could see a lot of the puts today. There was a lot of buying, and you could see things like NTNX, Coop, Vive, high beta stuff. KWeb, this came out after the announcement that Trump was going to make, or the headline that Trump was going to make an announcement after the close. DHI, some puts were bought. We've got housing data in 2 days. And then there's index puts, which I didn't include on this, just a little bit, just some of the bigger ones like IWM. But there was a lot of SPY and Qs puts as well. So good index put buying as well. If you use that as a contrarian indicator, you know that we're getting pretty washed. This was a washout day where people were really buying a lot of puts. So again, sometimes people use that as a contrarian indicator to buy when people were really getting fearful. It's a gauge kind of like a fear gauge. In terms of the option flow on the call side, you could see a lot of defensive things going up, or maybe some different things. Cigna, which I've mentioned, the chart looks pretty good in Cigna. Again, this option flow is late. We talked about Cigna in the trading room on Friday, so it still may work. But definitely, there was the announcement today that deal might go through between Cigna and Express Scripts. But we noticed this and put the chart out in the trading room on Friday to go long Cigna, or a possible long, I should say. XME saw some calls. That was one of the best performing groups. AMT, which I think this is an interesting chart. AT&T, we've been seeing this for about over a week. A lot of call buying in AT&T. Philip Morris saw some calls all the way out in March calls today. Some STZ calls. There was some IWM calls early, which has previously worked pretty well when there's been a lot of trade headlines. And what else? So, if you want to hear more about this report, this is a system called OptionX, which I'll be giving more guidance or more color about what it is. But it's a pretty sophisticated system that we've got that will actually spit out alerts, categorize them for you, aggressive or very large orders, and as well as spreads and ETFs. So first time I'm actually showing this, and I've had a couple questions on Twitter about, hey, what's the system that you're using? But we haven't rolled it out officially to the public. Right now it's just for Tribeca Trade Group members can get access to it, to the product. All right, so that's it for today's recap. What was the one chart I was just going to show? But I think with the growth names, I think just give it a little bit of time. Don't need to necessarily catch a falling knife. When I'm buying stuff on a dip, one of the mistakes that I made previously was buying things that were either too close in maturity, and I wasn't scaling in. I was buying too much at once. What I do on days like this is go out. I was buying a little bit of IWM going out to October. So again, giving myself time and giving myself plenty of room to kind of add more. So that's the plan. And then sometimes on day 2 or day 3 of a pullback is really when you can get that reversal day. So we'll see. We'll see how it goes, but that's kind of the plan. And then we'll see how option activity is tomorrow, which is a great barometer when you have an increase in volatility. All right, guys, thanks for watching the video. Have a great night. See you tomorrow.